I'm Sean Aylmer, and this is a Fear and Greed extended interview. All the other good bits we couldn't fit into the daily podcast. If you're looking for the daily episode of Fear and Greed, check the podcast playlist. Otherwise, enjoy the interview. I've spoken a number of times now about big companies and fund managers making the shift towards sustainability. Now, in a move that's sure to put others on notice, Mercer, a very influential player in the world of funds management, has committed to achieving net zero absolute carbon emissions by 2050. And the global giant is starting with Australia, with a target set for its Australian funds and the Mercer managed investment options within Mercer Super. There's more than $36 billion in assets under management as at the end of last year. Kylie Willment is a Chief Investment Officer of Mercer Pacific and is my guest this morning. Kylie, welcome to Fear and Greed.
Thanks, Sean. Great to be here.
So take me through the announcement made by Mercer and what it actually means.
Sure. So, Sean, I'm really pleased to announce that for the assets that we manage in Australia, Mercer is committing to achieve net zero emissions by 2050. Now, that target is aligned with the goals of the Paris Agreement, which seeks to limit global temperature rises to well below 2 degrees. But 2050 is a long way off, even for long-term investors like superannuation members. So we've set ourselves a nearer-term measuring stick, if you like, with the expectation that in order to achieve net zero by 2050, we will need to reduce our carbon emissions within the portfolios by 45% by 2030.
Okay, I have had a Mercer super fund in a previous role. So what that means is the money I'm putting in my superannuation, where that money is going to, where it's invested in, it's going into assets which have net zero carbon emissions. So does that mean that you're only looking for particular assets in certain industries? Is it that you offset one against the other? How does it work?
Yeah, so we're very focused on the transition of the whole economy and indeed the whole portfolio. So when we've been making or considering making this commitment, we've analysed the portfolio and all of the companies in the portfolios on the carbon transition spectrum. And so just to simplify that a little bit, we've got a spectrum that we call from the greys, which are the heavy emitting companies that have little capacity to transition to a lower carbon world.
For example, maybe oil and gas type organisations? Yep.
Yeah, coal companies, exactly, through to what we call the greens. So that's the climate solutions, new technologies in order to get us to a lower carbon world. Renewable energy, obviously, assets would be an obvious example there. And then, of course, we've got the in-betweens, and they're all of the companies in the world that have some level of carbon emissions and some capacity to be able to transition to a lower carbon future. And so we're really taking this holistic approach, which over time will see us reduce the exposure to those greys, will see us increase exposure to the greens, and for those in-betweens, really use our influence and our portfolio positioning to move that rump of the portfolio really up along the carbon reduction spectrum, so that when we look at our portfolios in 10 years' time and 20 years' time and 30 years' time, we're getting towards that net zero position by 2050.
There's a lot to unpack in what you just said then. I'm going to start with the last part, the influence. It's interesting that Mercer and others now are taking steps to force people to move up the green curve. And, you know, when it's the shareholders, which Mercer is a shareholder in these companies, it really matters because you own the company. How much influence do you have over companies?
Yeah, this is a really important question, Sean, and we believe that as shareholders or owners of these businesses, we have a really important role to play in using that influence to be able to drive change. And we think that is a much more powerful approach to just simply perhaps divesting from those grey companies, which in all honesty gives someone the ability to say, look, I don't invest in those companies. But the reality is someone goes and you sell the shares, someone goes and buys them, and the world just continues on its merry way. You haven't really affected too much change. Yeah. to affect the change, shareholders can use that influence. So you do that through engaging directly with companies. If you're a significant enough investor, you can do it through exercising your voting rights, which is a really important tool to send a message to companies. But I think more importantly for investors like superannuation funds, often we're not that close to the companies themselves because we often employ underlying investment managers. So we do two things. We're engaging with those investment managers and expecting them to engage with the companies on our behalf. And we can get involved in what we'd call collaboration with other investors because let's face it, we are all facing this challenge and we all need to get to that lower carbon future. So where investors have common challenges, it's very powerful for them to join their funds under management together and use that collective voice to be able to drive that change. And there are a number of collaborative engagements around climate change on a local level, but more importantly on a global level. And so there's a number of different ways and avenues through which investors such as Mercer and superannuation funds are able to really use that change in influence.
Kylie, stay with me. We'll be back in a minute. My guest this morning is Kylie Willment, Chief Investment Officer of Mercer Pacific. It was really interesting during earnings season that the engineering companies, the pipeline companies all came out and said, we're looking for opportunities in renewables. We're looking for opportunities in greener areas. Obviously, they feel the breeze and know which way it's going. Are companies significantly more willing to shift greener, for want of a better term, because that's where they see the future? So is management thinking more about it?
Yes, I think we are absolutely seeing some signs of that. And, the momentum behind the commitment to achieving those lower temperatures, alignment with the Paris Agreement and commitments to net zero by governments, by investors and by companies around the world is truly gaining momentum. And I think at a company level, they are waking up to the fact if they want to survive and they want to continue to attract investor dollars and therefore generate returns for their shareholders, they need to adapt and change and get on that transition spectrum themselves and make sure that they are moving up along the spectrum. And so investors and shareholders have been part, I think, of making companies lift their heads up and make those kind of commitments themselves. But also we know that the regulatory backdrop and the commitments from governments around the world is also becoming supportive of this. And so the time for head in the sand, I think, is starting to pass.
So I want to go back to your statement a moment ago. Also, what I've noticed with some big investors, it's not just a matter of saying, I won't invest in a grey company or I will invest in a green company. It's also a matter of saying, I'm keen on investing in a company that's changing colour. So it sort of gives the opportunity to invest in energy companies, are good examples, who are trying to shift from fossil fuels to renewables. It's almost an encouragement, and there have been some great Scandinavian companies who have gone from oil companies basically to wind power. What's your take on investing in companies who have seen the light and are shifting?
Yeah, absolutely. And I think that really explains the whole approach that we're taking, where it is very much focusing on this transition. And so if you're a company that's down that grey end of the spectrum, where perhaps you are a heavy emitter today, and when you look at it on the surface, maybe not a lot of potential to transition. But if you're a smart business and you're recognizing the change that is happening and I think is becoming more and more inevitable every day, you need to pivot your business, you need to adapt and you need to change. And so where we look at those companies in the grey spectrum, this is why we don't just want to divest from them. But if those companies can be smart and get themselves on the transition spectrum, then of course they can be part of that journey, which makes them a much more viable investment over the long term and gives them the ability to continue to attract investor dollars. And so that's absolutely the approach that we're wanting to take. And when you're down that grey end of the spectrum and you're not adapting and changing, then they're perhaps the companies that we would see over time perhaps just fall out of the portfolios because in essence they become redundant.
It's hard to argue against what you're saying, But at the end of the day, we're all worried about how much money's in our pocket and how well our super fund is doing. Is there a financial impact one way or another on what you're doing?
Yeah, again, another really important question. And of course, these net zero targets, they're aligned with an environmental goal, while investors' goals are first and foremost to generate a financial return. And I think often there is that perception that achieving the environmental goal is not aligned with the financial objective, and perhaps you need to give up one to achieve the other. Now, we don't agree with that point. And over the last few years, we've conducted what we call climate scenario analysis on our portfolios. And that essentially means we take a forward-looking view and we test our portfolios and their expected long-term returns under different warming scenarios. So say from 2 degrees to 4 degrees. And the results of that analysis tell us that our portfolios are likely to do better under those lower warming scenarios and worse under the higher temperatures. And so when you couple those results with the fact that the momentum behind the transition to a lower carbon economy is picking up pace rapidly, we actually believe that reducing emissions under sensible and pragmatic long-term plan is very aligned with that financial best interests of investors and return generation over the long term.
We'll be back with more in a moment. I'm talking to Mercer Pacific's Chief Investment Officer, Kylie Willment. So what's the investors' response been to you? I mean, your own clients?
Yeah, sure. Well, overwhelmingly, the response is positive. And in making this commitment, first and foremost, we took into consideration the financial case and our need to generate strong long-term returns, but also in consideration of what we believe to be the feedback and some of the preferences that we get coming through from our clients and our superannuation members. And that feedback told us that most of our investors would welcome this commitment. And it's fair to say that climate change and our actions in relation to it is probably one of the most common queries that we receive from our investors. And so we have factored climate risk and opportunities into our process for quite some time. But I think now it's great to have a strong and clearly articulated commitment and plan around what we expect from the portfolios in terms of reducing emissions.
Do you think eventually the rest of the managed funds industry will do the same thing?
Yeah, look, momentum behind these kind of commitments is really gaining. We've seen a number of superannuation funds in Australia make similar commitments. Certainly when you get offshore, there's a lot of momentum behind investors making net zero commitments or some version of a carbon reduction strategy. And indeed, I think one of the reasons why we make this a public commitment rather than just getting on with it in the portfolios is because we want to influence others to do the same. So when you think about the point I made earlier that we expect our investors to do better under those lower warming scenarios, the more investors that can make the commitment, the more likely that scenario becomes. And so therefore, the better off we expect our investors to be. So there's some very strong connections here.
And you must be pleased that Mercer, is a massive global firm, must be pleased that they're starting in Australia.
Yeah, absolutely. So Mercer is a global thought leader in responsible investing and has pioneered some very strong thinking around how to invest in a time of climate change. So the commitment that we've made for the Australian funds is very much informed by that global thinking, and we're really thrilled that Australia has been able to lead the charge on that. But while we are a global investment solutions provider, these commitments do need to be made locally in consideration of local governance structures and regulatory frameworks. And so while Australia is leading the way, I know this is a very active consideration for Mercer in other regions as well.
Kylie, thanks for talking to Fair and Green.
Absolute pleasure. Thanks, Sean.
That was Kylie Willment, Chief Investment Officer at Mercer Pacific.